as I mentioned in the description of this, I sit in this space all the time. Like, I'm always looking at investment and funding and VCs and all of that conversation. And one thing that I particularly sort of noticed is that actually we don't talk about the basics. And there are two types of startup that I typically work with. There's the ones who absolutely know they're going to want investment, and they tend to be really, really clued up with everything and know all of the details of the different mechanisms that are there, but they just need help getting there and making sure that what they offer investors is kind of worth it. There's another group of businesses who almost think that they're going to want to grow organically. They're not quite sure of how big they want to get, so they're not sure that investment is something that is going to be useful for them. And then as they start to grow, it's like, oh, how do I do this? Because it's never been kind of on the radar. So what I wanted this morning is to go through like the real basics of how do you consider being ready for investment, and then what do you need to do in order to prepare for it. Now, if you're a brand new company, first year or so, and you've got a proof of concept and you're looking to scale that up, that's one scenario. Typically, though, there's the other scenario of a company that's been going 2 or 3 years. They've started to make a little bit of momentum. They know that they now have the right formula, but they just need that cash injection to help them to the next level. So I'm going to try and cover all bases, but do feel free to put any questions in the chat. I will try to keep an eye on it as much as I can. Feel free to talk to each other in there as well. That's fine, because this is recorded anyway, so you can just listen to me afterwards. So when you're thinking about any kind of funding decision, you have to think in terms of 3 questions. First, do I need funding? Second, do I want funding? Because they are 2 very different things. And 3, how do I get it? Right now, what I find when I start conversations with startups, they've answered maybe 2 out of these questions, but not all 3. And once you've got all 3, your pathway becomes a lot clearer. So if we start with, do I need funding? There's a number of ways that you can think about this, just to understand kind of what mindset you need and what kind of considerations to make. So the first one is, are there opportunities for organic growth? This is really important because if you can do organic growth, you should absolutely do that. Some of the largest companies in the world grew organically. So we've run into this myth that the only way to get really big is to have to bring on investors. But there's always ways of growing organically. It does slow things down a little bit because you're effectively using the profit from before to then reinvest. And obviously it's incremental, as opposed to this large cash injection that is always going to solve problems a lot quicker. Also cause some though, so but organic is definitely better. And as I go through the slides, you'll see why that is, because with investment comes other challenges. So how much is it that you actually need? And beware of the financial no man's land. So this is kind of connected but separate points. Too often we'll just pick a number from random, like, oh, if I had a bit like when you think of the lottery, right? If I won £1 million, that'd be great. But we don't actually sit down and think exactly how we're going to use all of that cash. When we start thinking of investment, you have to think of it in terms of very specific things that you want to purchase or invest in yourself in order to grow the business. So it's like a formula. Give me this much money, I'll do this with it, and this is what will come out the end. So you have to be really calculated about how much money you need. Now, sometimes if you're not quite sure, you can keep it with just the concepts. So you might say, well, some of it will go on marketing and some of it might go on making the group bigger, hiring more people. Some of it may be to buy more equipment, right? So you can kind of chunk it up in that way, but you do need to be quite specific about what it is you're going to use your money for. The financial no man's land is connected to this, but slightly different in that it is partly about understanding how you're going to use the money. So when an investor says to you, okay, so say I give you your money, what are you going to use it for? You don't want to give them a blank face like, I don't know, I just need the money. But this is also about this section, which, because we have this kind of inbuilt feeling that asking for more money is bad, right? We always try to minimize the amount of money that we actually ask for. The problem is, if you're going to have investment, you may as well ask for the number that's going to make serious changes. And what can happen is you can get into this cycle and have just enough money to look like you can grow, but not quite enough to actually grow. And so you just end up, oh, I can't quite get there, I can't quite get there. And you can translate that into investment. So if you're thinking, oh, I don't want to take too much money, I don't want to ask for too much, you might lower the amount that you're asking for to give you the bare minimum. That's just as bad as asking for too much, because if you have to do a lot of scrimping and saving in order to get to that next level, the investment isn't going to feel worth it, and you're going to just stress yourself out. So always be mindful, make sure you know accurately what the number is, but also allow yourself a certain level of generosity in making it a comfortable place, because otherwise you might as well continue to grow organically. What's your path to revenue generation? Now, I speak to startups on the daily with companies who are looking to, this is their seed funding, and they already know there'll be a Series A and there'll definitely be a Series B. And for me, there's this rationale that says, at what point do you actually start making the money for yourself as a company, right? It is so easy, because this huge lump sum of money comes towards you, and you think, great, I can build something amazing. But it's got to start building something for itself, right? So there's always got to be a path from this investment money allows us to grow in this way, because ultimately you don't want to be thinking of your investors as the people who are keeping your company going, right? It has to be you, and you're generating the income, but you can see areas where with a little bit more investment and focus, you can take your business to the next level. So you always have to think of, how is this going to make money? And how do you plan to grow and scale? So there's two sort of forms, right? You can either go up or out. So some people grow by becoming super niche, and they grow tall. So they get really, really good at what they do, but they focus in on that one thing. And their growth comes from being able to charge more because of that level of expertise. Others will grow outwards. So they will grow because they add more services, more people, and they just generate more income. But they stay relatively, there might be some specialization in there, but not a huge amount. It's usually quite generalized product that's offered, because it can be delivered by a team of people, and it's not so beholden to one person with all the knowledge. So thinking in terms of that can help you understand, when you're thinking of growing, where's that money going to be used for? Is it to maybe take more training or buy better equipment so that you can be the only person who does what you do? Or are you thinking, I need to build teams that can go out and win business on this kind of branding suite of products? So that's some initial feeling about, do I need it? So thinking in terms of, okay, so I've worked through all those questions, and now I'm going to look at, I think I do see the benefit of adding a certain amount of money to my business that will allow me to grow a little bit bigger. So now what? right? And we've got you to that point. The next point is to actually start looking at the funding options. Now, this may very well change your original question. And this is why these are 3 questions that all have to be answered. Because as I go through the different options, you may think, oh, actually, I don't really like any of them. In which case, you go back to the strategy of how do I do this organically? Or there might be one that you hadn't thought about and think, oh, actually, if I had access to that one, then my plans to scale would maybe change somewhat. So I'm going to go through all of them, but the trick with all of this is the 3 questions have to be answered all at the same time. So I'm giving you the information, but always think about the other 2 to make sure that you're in line with everything that I'm talking about. So the first one is the fairly typical, just going to your bank, right? So banks these days will have some form of business manager. It is provided on very different levels. Some are just virtual, some will still be in branch. But they know that as a small business, your potential to grow bigger means that you are a really good customer for them. However, you will also know, having talked to your bank, that until you're at the point where your bank account is nice and healthy, they don't feel particularly helpful, because they're still not sure whether you're going to survive or not. So if you're right at the beginning of the journey, the bank may not be the best option for you, because they do need that information and that certainty. But if you've been using your bank for a little while, it's always worth a conversation. So the good points of using a bank: very, very safe. They know you, they've got a sense of who you are as a business. If you have had a business manager, you'll have had time to think through what your approach is. Sometimes they ask you lots of questions about what your what's your vision for your company. A few years ago, if you started a business, you absolutely had to do the interview with the business manager and give them like your business plan, and then they go through it and assess it. They don't do that anymore. Thank goodness, because they weren't very good at assessing business plans. But they're trying to get a sense of who you are and what your ambitions are. And that can help when things go well, and also when things are a little bit more haphazard. The good thing here as well is that terms typically are fully agreed up front. So you know exactly what you're getting into. So whether it's a loan, whether it's credit financing, whether it's some kind of credit facility or debt financing, whatever it is, your agreement will be there before you sign on the dotted line. You may think that might be the case with all of the investment opportunities out there, but it's really not. And that's why I think it is a plus to go through one of these larger financial institutions sometimes. However, there's always a bad side. They are very, very slow. Like sometimes just opening a bank account can take 6 to 8 weeks. They go through a process called KYC, which is Know Your Client. And Know Your Client is a culmination of lots of times where they allowed the wrong person or the wrong business to slip through. So what they do is, instead of kind of looking closely at that individual instance, they just add another level of due diligence. So this is not just about you and your credit history. This is also about what your business is. Can they find any links to any countries that they are not allowed to deal with? Can they understand the way that the money is going in and out of your account because of money laundering? It opens up a wild set of assessments, and you just think, I'm just here with my little bank account, just wanting to do something. But there is a really long process that you have to go through, tons of paperwork. Typically, a bank will ask for 3 years of accounts as well, which can make it really difficult. But if you are having the relationship with your business manager and you've got those 3 years of accounts, then at that point, the banks become a very safe, albeit laborious, option. Next is your local authority and government grants. So if we take away the whole argument about the is it a grant not a loan that the poor chancellor has just been through, where he couldn't describe what a grant is and what a loan is. A grant is money that is given to you without any requirement to pay it back, to help you grow your business in key ways that align with either the local authority or the government's manifesto or agenda. So no repayment, really, really good. And you can use it for capital purchases. So say you need a new piece of machinery, or you wanted to buy a new I don't know, warehouse or something like that. Something that's quite chunky is really good for using a grant for. As I say, if you are aligned with their particular agenda, then the money is there. So even if you go on their website and you can't necessarily immediately see a grant that would work for you in your business, it's well worth having a chat with them anyway, because they're not always sector aligned. Sometimes they're the type of purchase that you're going to make. They're down to the type of person you are, so the location of where you are, if they want to stimulate the economy in that way. So always worth having a conversation, because there might be one that you have overlooked. The downsides, they are usually quite specific criteria. The days of the COVID grants, where things were fairly broad and almost anyone could apply for almost any of them quite easily. Typical grants are very specific, and they're designed to help build the company so that success you have as a bank, as a business, sorry, then help stimulate the economy, whether that's in more jobs or more opportunities, or just, you know, getting eyes on an area. They are, again, very long applications. There's a lot of information. So I think a few decades ago, somebody created a business plan template, and ever since, local authorities have been using it to give grants away. Most of the questions appear to be fairly irrelevant for a lot of the companies that are now out there, and not really keeping up with the times. There are specific people who you can go to who can help you fill them all out, and they will know exactly what is needed in every box. But it's it is a long process to even get through the form. And the third one, which I think you do have to be very careful of, is with a lot of grants that are out there, you can't use it to build your team. Now, it sort of makes sense because it's a one-off payment, and they wouldn't want to set it up so that you hire somebody based on that payment, but there is no certainty that you'll be able to continue it afterwards. So if you're thinking, oh, I could get a grant and bring on a new member of the team, you have to look very closely, because the chances are you probably won't be able to, because they wouldn't want to create jobs under that grant money that aren't sustainable past that. And I know quite a few people who have put hiring requests as part of the overall business plan, and it's got rejected because that was included. As soon as we took that out and put it back in again, it was fine. But it's just something to watch out for. This is the one that, if you live in social media land, you'll most likely have heard of, the angel and seed investors. Now, I have a very particular definition of the two. I don't know many people who actually stick to this, but I think it helps make sense of the distinction between the two. So an angel investor is supposedly someone who is prepared to give you money in order to get to proof of concept, right? So you've got an idea, you're completely not sure whether it will work or not, but there's some research you need to do, so a little bit of development, and you'd need funding for that. An angel investor should be traditionally can talk about returns, but they bear a large piece of risk because there's no proof that they will get their money back. Like it's not there. It's a high risk investment because they are literally just giving you the money and going, here, have it, see what you can do with it. If you ever look into the history of well, he's an actor, but he's also well known as an investor, Ashton Kutcher. He gave money as an angel investor to things like Twitter and to one of the, like PayPal, not PayPal, but like PayPal. And he will say it regularly, I had no idea whether I get the money back, but it was a cool idea and I wanted them to be able to give it a go. That's angel investing in its purest form. Seed investors are when you have a product, you have something ready to go, and it is, think of it in terms of they're helping you plant the seed, right? So they're helping you get that grounding. So there is definitely something there with a lot of potential. They just need to help you facilitate it, right? Now you can probably tell why the two get confused so much. And there's a lot of people who call themselves angel investors when they're really seed investors. Not many seed investors who call themselves angels, to be fair, other than people know the term angel investors a little bit more now. Anytime there is a assessment of the risk involved, the type of investor will change. So angel investors, huge risk because they have no idea whether the idea's got potential. Seed investors have more idea that there's potential, but it needs to be proven on the market. And then you've got the, you know, the VCs and whatever who will be looking at the sure bets because of the amount of money that you're asking them to put in. Now, this group is one of the only ways to get smaller amounts of funding. By smaller, I'm talking anything under £1 million. We have quite a challenge in the startup ecosystem that the vast majority of companies will ask for kind of 100K upwards, and yet there's almost nothing to facilitate in that space. It's all down to angel investors giving you small amounts. So say you were after 300,000, you might find 10 people at 30,000, or you may find 3 people at 100,000. You're unlikely to find one person for the whole lot. So you're having to deal with like a group of investors. But they do allow for this resource because a lot of angel investors are people who have personal access to wealth and they want to get involved in something. So, you know, it becomes an option for them to use. This is particularly, you will have heard terms of SEIS and EIS. These are particular types of, I guess certification is the best way to say it. If you get CEIS approved on your project and on your investment, then there are tax benefits to an angel investor who gives you money. They can charge for it in a different way, which is what makes it so attractive to them. But it does mean that the amounts will be a little bit smaller. And as I say, angel and seed investors can be sold on a concept. So as long as you've got some kind of minimal viable product, you've got some kind of traction, then angel/seed investors will go for it. They'll, you know, and when you pitch to an investor at angel level, most of the pitch is about them buying your idea rather than just looking at the hard numbers. But there is an awful lot of angel investors out there who have not done it before. They genuinely think that Dragon's Den is like the obvious way that things happen. However many times I tell them it's not. And so as an inexperienced founder talking to an inexperienced investor, that conversation can be really messy. And everyone's kind of scrabbling about in the dark a little bit with what needs to be done and what pieces of paper need to be signed. And so it does cause issues. I heard of one company who was after, there was an investor for like a 10 grand raise. It was just a small investment. but the amount of paperwork that he gave them to complete, because he was like, no, this is the due diligence I need, it was worse than when they got VC money. And it's all down to just not really knowing what they're doing as much as you think they do. So you watch out for that. The agreements can also be quite fluid. So you can talk to them about how much they're willing to invest, and the number might swap around a little bit. And it's unfortunately not unusual for them to pull out very abruptly. During the pandemic, there were several startups that I worked with because they had investors. The investors had transferred the money over to them, but as lockdown hit, they called them and went, oh yeah, I need my money back because, you know, the lockdown. So it's quite a risky thing for you guys as founders to have without a really solid legal agreement underneath. So it's a great avenue for getting smaller amounts of money. It can be quite risky if you don't make sure that someone in the process actually knows what they're doing. Don't assume the investors do. The next one is funding organisations and family offices. Now, I've bulked these together, but they're quite separate things. Funding organisations are organisations that are trying to connect companies looking for investment with investors. So they act as a go-between. You can also find people very much milling about on LinkedIn who would consider themselves brokers, doing essentially the same thing. I've got a list of a little black book of investors, and then they go out talking to the startups and they try to make the introductions, and their own revenue is generated by the introduction fee. Family offices kind of sometimes they act in the same way. So families here are the very, very high net worth, ultra high net worth families who have a massive portfolio of things that they invest in, and they will have a family office who will come in and manage that for them. So in very much the same way, the people in the family offices are connecting you with the investors, and they're acting as the go-between. So they are a facilitator of the conversation. They can help translate between the two of you, make sure that everyone's really clear. So when there's any questions, they can either answer them themselves or go and ask the other party. They can also take a really active role in finding the investment and beyond. So some brokers and funding organisations will help you find the funds, and then they will provide advisors or mentors or some kind of support structure as you use that money, partly to give the investors more confidence that their money is safe, but also because part of their intention is to make sure it works really well. Because if somebody succeeds, then obviously that's a great advert for their own company. But as much as they can facilitate, they can also be a gatekeeper. It can be extremely difficult to talk to the investors because you've got to get past these people in the middle. And sometimes we're definitely seeing more and more founders going direct to investors because they feel like if they could get to the investor will understand the concept. Mm-hmm. There is a challenge with some of the funding organisations and family offices that the people running them can run the office really well, but it doesn't necessarily mean that they're good at assessing investments and assessing opportunities. And you know, I know of a couple of experiences where the advisor, the broker in the middle, has actually broken down an agreement because they couldn't understand the concept, and both the founder and the investor were really unhappy because it would have worked. It was just the person in the middle kind of getting in the way of it. You may also not want them to be so active. So if you have already got some form of advisory board, if you feel quite confident that you know what you're doing, the idea of them placing someone with you to kind of oversee what you do may not appeal. And so you have to bear in mind the terms of the facilitation that they're offering. Lastly, we're going to talk venture capital. So there's lots of VCs, new ones popping up all the time, others disappearing without trace. You'll hear of things like YC Combinator, that's one that's kind of bandied about quite a lot. There's Overlooked VC is a new one over in the States, looking specifically to work with founders from underrepresented communities. So the concept behind venture capital is their sole focus is on pulling money in from investors themselves, and then they manage the pot of money that then goes out to people. So venture capital organizations don't naturally have money. They have a ton of investors who put money into them on the proviso that they can choose usually quite high yield opportunities. They're high level and high value investments as well. So they don't want to be managing lots of tiny investments. They want the several multi-million pound ones so that they can really get to grips with it. It's easier for them to manage. But some of their time is almost entirely focused on their own investment journey. And it's one of the problems we're seeing at the moment is they are falling foul of this process as well, in that the investors who said they would give them funds now are pulling back because the word recession is out there and everyone's kind of losing their mind. Half the investors seem to have put a little bit too much in crypto, but that's a completely different conversation. So VCs are for large scale propositions with usually in the multi-millions. So really useful if you're trying to scale up really quickly, if you're creating a product. So if you need, for example, a factory to produce your goods, then venture capitals are great ones for this, because they predominantly look for longer term investment opportunities. So they're looking to be in place and then stay in place for a long time. So if you imagine the vast majority of these, your return, the way that you pay them back, will be sometimes through a repayment, but most of the time through the equity that you give them. Now, when you're small, it might not look like your equity is worth much, but the job of a VC is to work out what that could potentially be and make sure that overall it's very profitable. So you might ask them for, I don't know, £10 million. They work out that if your idea hits the market in the right way, it could make £200 million, and therefore their 10 million is a drop in the ocean, because every year they will be getting dividends and payments back. So they look at things in quite a long-term perspective. But for that, they can want more control of the company as well. So it's not unusual for them to want a seat on the board. They want to have their advisor in there with you, all of which could be really useful. But the difficulty as a founder is you want to have the money so that you can see your strategy play out. And sometimes, because of what the VC themselves are looking to get out of the investment, you might find that person is problematic in helping you achieve what you want. This is why organic is so much better, because the more people involved, the more people you have to satisfy with how you're running your business. And particularly if you've got used to running it yourself, it's quite difficult to then go out and ask other people and have to wait for their approval for you to do something. The last thing with VCs is it's all about the numbers. They don't care as much about your business as you do. And that's fairly typical of investors across the board. But with VCs, it really is all about the numbers. So however much vision you have, however inspiring your pitch deck is, they will almost certainly hold the conversation until you've shown them your financial model, because they need to make that calculation of, if we invest this much, how much does it look likely that we will be getting back? So it can be quite disheartening for founders, because you are so passionate about your business and they just don't seem to want to know anything other than the raw data. So it can be quite soul destroying when they say no. They're not saying no to your idea because they haven't really thought about that. They've said no to what you've predicted in terms of your financial growth. So hopefully all that makes sense. As I say, organic is always better because you retain control. You have less to deal with in terms of the administration and trying to figure everything out. But say you're thinking, okay, so I've looked at all those and now I need to understand, okay, so I'm saying yes, now what? Right, so this is the third question. Your first steps are, they will want to see a clear operational plan. Now you might, if you know me, you know that obviously that was the first thing I was going to say, but investors do care about it as well, right? Particularly if you're already launched, they will want to see your actual plan, actual numbers. They'll want to see what your business plan is, and they'll want to see, like, you know, your 3-year strategy or your 5-year strategy, because they want to see that their money is safe, right? Two things that investor cares about: their money is safe and it's going to make them a return. That's it. So an operational plan helps them understand that you see this as a long-term situation. Now, if you are thinking, well, in 3 years' time, I wanted to just sell, that's fine, that you can plan for that. But what they want to see is that you're planning to sell at a particular level, or that you want to get to a particular size before triggering that. As long as you look like you're thinking of it as an ongoing concern for somebody, that gives them the sense that, you know, this might be something that could be quite lucrative for them long term. They will want a financial forecast with actuals and forecasts. So I see a lot of financial forecasts, as you can imagine, and the vast majority of them are really good at telling you, like, your cash position right now, you know, whether you can afford to bring someone on. But a financial forecast kind of builds over time. So what you typically find is your first year, you have to go kind of month by month, because you've got nothing to base it on. After the first year, you've got some data. You know kind of when the most revenue comes in, you know how much the previous month cost. So forecasting is just that, right? What did it cost me last month? Has anything changed for this month that would change that number and make the adjustments necessary? So you do that kind of on a rolling basis. It is really important once you're launched to get your financial model and then start putting in the actual numbers as you go through. So say, for example, you wanted to do one this year, you wanted to raise, you might do a financial forecast for 2022, but half the year would be actuals and half would be your forecast. And then 2023 would be pure forecast based on what 2022 told us. So you see, it's like this very active viewpoint of your financials, because again, that tells you really good information, like, can you afford to bring someone else on? Can you afford that new equipment? Because you're not just looking at, is the cash in the bank today? You're looking at, will it be here in 6 months, 12 months, and so on. So always make sure you move with the actuals as well. Again, when investors want to have a look, they want to judge whether the numbers you're giving them are realistic. And so the actuals can help them see whether that trajectory kind of makes sense. The numbers tell the story of your business just as much as your narrative does. So when I look at a financial forecast, I'm looking for consistency. So do I see the type of things on there that I would expect to see? Do I see a pattern? Do I see a logic behind how numbers have been put in and extrapolated out? And what does it tell me in terms of how the company is going to grow? So if your forecast is six people, right? So I've seen ones where you have one line and it says, I'm going to hire 6 people. Okay, you know you need 6 people, but you don't know when, and you might you might get one in first, and then another couple a few months later, and then maybe the other 3 6 months from then. Forecasting is at month level. So if you want to hire people, you stagger it to where you think you will bring somebody in. Very few people do this. When I was in large corporates, this was also the bane of my life because managers would tell me they want to hire like 3 or 4 people, and they'd start them all from January the 1st. It's like, but that's not going to happen, is it? If you can think about the numbers rationally, then that tells the story. Yeah, I want to grow. I want to bring these 3 people on because they're doing this type of role. That's going to help generate more sales, which means I can bring these people in later. You see what I mean? It's the numbers kind of support the journey that you're telling them. So when you're saying, this is how I'm going to use your money, the numbers reflect that narrative in the right way, and it doesn't look just like they're sitting dormant on the spreadsheet. They also typically want to see the business plan. You know, I'm not a fan of business plans, but they do want to see one, plus the first post-investment 100 days. So the concept of 100 days comes from more like leadership, in that if somebody takes over a senior role in a large company, we talk about their first 100 days. You know, we do the same with presidents for some reason in the US. So you've got 100 days. This is because this is the time where you can have the maximum impact. So what they want to see is, right, the money goes in on Monday. What does the rest of that week, month, year look like? Like, what are you going to be actually doing with the cash? So them understanding that hiring as well can really, really help. Do they believe in you as a founder? So do they think that you are capable of taking their investment money to where they said you were? Now, obviously, as I said before, if part of your strategy is to exit at some point, you may think, oh, well, it doesn't matter about me. It absolutely does, because if you're going to exit, they will want to know that you're exiting a company that's stable, that's capable of doing without you. You don't want to be a single point of failure. But you also don't want it to feel too different from the ethos that you've built up. So how you are as a founder is really, really important. And then the pitch and the plan. So once you know how much money you want, what kind of investors you're going to go after, and thereby knowing what kind of focus you need to put on in the pitch deck, you have to then create a document that explains that narrative, combine it with the plan. The idea of bringing the two together is to show them the current reality to the future potential of your business and the future promise. So like I said before, this is what I have now. If you give me this much money, this is what I can make of that money, and this is what the outcome would be. You have to really take them through that process. And even if you're talking to a super experienced investor, assume that they don't know anything about your business. Like, assume that you're taking them through, this is my business, this is where it sits within the industry, this is kind of where we are in terms of our potential, this is my idea, your money would help us get here. You know, it feels a little bit like spoon feeding, but you absolutely have to do it, because they don't necessarily know anything about your industry. They may be talking to you as a fairly generic investor. And so the more information you can give them, the better. So in summary, organic, always the best option. Always have a strategy where you don't need the funding. That means that you will never get into that block of, I can't do anything because I haven't got that funding. Very few companies are non-existent without that investors coming in. And most of them wouldn't even have got going if they really were like that. So always have an organic option. Choose investors carefully. It can feel quite difficult to find investors, and then trying to make sure that you know, for me saying, oh, but make sure they're the right ones, might be like, oh, I've only just found one, I can't be too choosy. You absolutely do. because in some cases, as I mentioned, you're going to be working with this person a long time, and you have to be in sync. They have to understand what you're trying to produce and be supportive of that. You have to be able to accept feedback from them, potentially challenges, and that there has to be a full relationship. It's not a faceless system that you're using. And so, you know, this isn't a computer says no situation. You have to make sure that the person who's investing in your business is the right one for your business. What can happen is I do love my game theory, and pitching to people for investment can really turn into a game of, can I make this person invest in my company? When we don't get the right signals from someone, it's really tempting to sort of dumb down our argument and eventually just become complete, just begging them to invest. Now, what do you think that does to the dynamic of that conversation? You open yourself out to much more risk of expecting higher returns. So maybe they want a higher percentage rate back, maybe they want higher equity. And because you framed it as you're kind of desperate for the money, the dynamic is completely with them. It's far healthier for both of you if it stays equal. A pitch is their opportunity to getting a ground level to something that is going to make them a lot of money. It's an opportunity for them. Yes, as a founder, you can do your little like happy dance when someone says yes and be like, yeah, somebody believes in me. That's absolutely fine. But in the room, when you're pitching, it is an opportunity that you're giving them that has substantial value. And that way you just make sure that dynamic stays as it should. Really understand the level of compromise that you're going to have to make. So once you insert somebody else in any way, shape or form into your business, whether it's as an investor or an advisor or whoever, they are going to have a different viewpoint about something, right? Whether it's how you spend the money, what markets you go into, what products you focus on, they're going to have a level of understanding or opinion. And you as founder have to understand how much of that are you prepared to give and take on. Like if you're passionate about what you do and there are some absolute red lines, then you need to make sure they're extremely clear to investors as you start talking to them, so that there can be no misunderstanding as to what you are going to compromise on and what you can shift. But there will be a level of shift. There might be things that you really wanted to do straight away, and because of their terms of investment, you might have to change it around a little bit. But know your red lines and then know where you can produce that flex. And that's it. I've gone through quite a lot. That's why I recorded it, because I want you to be able to go through it and kind of pick and choose the bits that are most useful to you. I will stay for a couple of minutes to see if you have any questions. I know I've gone through quite a lot, so your head's probably spinning. But Alita, is that a thumbs up that you haven't got any questions?
Oh, no, I think it's amazing whenever you write something, or whenever you, and take this the right way, whenever you open your mouth, everyone should just stop whatever they're doing and lay down their tools and listen to you. You are just clarity personified. And I kind of thought that the thing is when you're working on your own, you have all these sort of notions and strategies and ideas, and they because I work completely on my own, so there's nobody to bounce the ideas from. And then to hear you lay it all out on the table, and it just gives so much clarity. And I still don't know, though, whether I need an investor or not, but hearing you say about growing organically is just, is music to my ears, because I've always really, deep down inside, that was always my gut feeling, just keep growing organically. However, there are stumbling blocks, financial stumbling blocks along the way because of that. And it makes it really difficult. So yeah, I probably do. I've been putting it off for some time because of, you know, financial reasons. As a startup, there's never any bloody money. It all goes straight back into the business. But I probably really have to consider at this stage now talking with you.
Any time, Alita. I mean, I thank you for that. That made me blush. I don't know if you could tell with the camera, but I think where you are is exactly where a lot of founders are. Do I need investors? Because you can go onto social media and see companies that are like yours, and the sense is, well, of course you need investment, of course you need to go and out there and get a big sum of cash, and that can be quite daunting, right? It can be quite overwhelming to think that that is your only option. But then the other side of it is also daunting, like how do you grow organically? And there are always methods, as long as you understand the organic growth will almost certainly be slower. Then you can create that plan. And you know, I know, so there's I don't know how many of you are au fait with social media, but there is a social media account called Lag Bible, which sounds you know, some like one of those clickbaity profiles. But I saw them 2 years ago at an event, and they were turning over something like £280 million. It was a ridiculous sum of money. And they were extremely proud that they had never taken any form of investment whatsoever, right? But he said it was really hard because you're just constantly pumping the money back into the company. But if you have a plan of how eventually the funding, the money will just start generating itself, you'll reach that sweet spot where your volume of sales will mean that you just get into this flow of revenue, rather than, certainly in the beginning, you have that feeling of like every sale is a fought battle that you've had to fight and win. Eventually there is this momentum, and then the pressure eases off, and then you can really focus on how do I grow this even more. But it is really important to keep both things in perspective. Investment helps, but creates its own challenges. Organic is better for you as a founder in sense of the control you have, but there are other challenges, and understanding really the question of what do I want this company to become can help you figure out which strategy that you want to go on. But yeah, we should definitely talk.
Yeah, you that's absolutely, yes, we should definitely talk. But you're absolutely right. I think that you know, I'm just coming to the end of my first year, and I'm faced, and I'm sure a lot of people too, after the first year, you're still sort of positioning yourself in the market. You know, you're still kind of you know, there in the long grass and deciding which way you're going to pounce.
Yeah.
And that's kind of where I'm at. There's several options, so it becomes a little bit overwhelming because there are options, and it's deciding which option is the best one to pounce on first, and then you know, and only then can you decide what and if one should go for the seek investment or not. Yeah,
absolutely. And it is important as well to remember, in your first year, it is highly likely that from the beginning to the end of that year, your business will look completely different. Like, just because as you start selling your goods or selling your services, you have to be able to adapt in that first year, because sometimes things will land really well, and other times the thing that you thought was going to be your biggest seller just completely flops, right?
Yeah,
And
you
so,
hit the nail on the
yeah,
head again.
and exactly. And so that first year, you have to anticipate that things are going to adapt quite a lot. Now, think of it, if you had an investor and you've promised them that you're going to have this perfect plan that's going to work immaculately, and then it
Pressure.
doesn't, you know, it's a lot of pressure. And I don't think, if you look at some of the larger startups that in sort of like the last 3 to 6 months have failed, they've had to make massive job cuts. And I'm sitting there in my space going, but how did you get to that point? How did you get all that money and not have a route through to sustaining people? It doesn't make sense to me. And I think it's because we listen to the myths of startups and the myths of entrepreneurship more than the realities. And you know, I'm quite a disruptive person. I want to change the world, but I also have a quite pragmatic streak in me that says, well, there's no point shaking the world up if I can't put it back down on a stable foundation. And so we have to do both. You know, you have a time for big thinking and what the potential is, and how broad and expansive it can be. But then once you've got that in place, you have to then be able to go, okay, so how does that happen then? And then go down to the action plan.
Yeah.
Cool. Well, thank you so much for joining me. I will put the recording on probably somewhere on my drives so that you can access it. Feel free to share it out as you need to. I just want as many people as possible to hear this part, so that when they do go on their investment journey, they aren't starting from, you know, trying to run too quickly into a conversation where they're not really sure where they're supposed to be anyway. but thank you so much for joining me, and hope to speak to you soon.